I didn't plan to move 30% of my portfolio into Fidelity ETFs. In fact, a year ago, I barely gave them a second look. Like most investors, I was stuck on the classics: Vanguard, Schwab, maybe sprinkle in some Dividend ETFs for safety. The advice was always the same: buy the S&P 500, hold it forever, and you'll be fine. Then something strange happened. A client I'd worked with for years, disciplined, diversified, did everything right, asked me why her returns felt average. Not bad, but not life-changing either. And that question kept echoing in my head. Why is doing everything right still not enough? So I dug in, spent weeks reading ETF prospectuses, backtesting performance data, comparing expense ratios, tracking down institutional flows, basically nerding out harder than I have in years. And that's when I saw it. While most retail investors were chasing meme stocks or debating VTI versus SCHD like it was the Super Bowl, $47 billion of smart money had quietly shifted into 3 Fidelity ETFs that almost no one was talking about. Not new funds, not some secret hedge fund deal, just solid, high-performing ETFs that were literally sitting right there and outperforming the S&P 500. These funds weren't just different, they were smarter. They combined intelligent stock selection, technology-driven strategies, and here's the kicker, they pay dividends. Today, I'm going to break them down one by one. I'll show you why I believe these 3 funds could be a better move for the next 10 years than most of what's hyped online. No clickbait, no hype. Just the strategy that made me rethink everything I thought I knew about passive investing. And by the end of this video, you'll see exactly how to use what I call the Fidelity Wealth Triangle to build a portfolio that actually works for growth, income, and long-term peace of mind. This is Golden Goals. I'm Mike. Let's get into it. The story that sparked it all. A few months ago, I was reviewing the portfolio of a client I've worked with for over a decade. She's the type of investor who does everything right. Regular contributions, diversified index funds, low fees, textbook. But when we looked at her 10-year returns, they were just okay. Not bad, not great, just average. And she said something that stuck with me. Mike, I'm doing all the right things, so why doesn't it feel like I'm winning? That hit me against Spiltuvi because I've heard it before from friends, from viewers, from other clients. And maybe you've felt it too. You're not messing up, but you're not building the kind of wealth that actually changes your life. So I started digging, and what I found was this. The problem isn't with index funds, it's with how we've been taught to use them. We follow what everyone else does, VTI, VOO, SCHD, because they're safe, cheap, proven. But sometimes the best opportunities are the ones hiding in plain sight. That's how I found these 3 Fidelity ETFs. They weren't built to be trendy. They were built to be better. Let's break down the first one. ETF number 1, FELC, Enhanced Large Cap Core. Think of FELC like the smarter cousin of the S&P 500. Most index funds buy the biggest companies based on market cap, no questions asked. If a company is huge, it gets in. But FELC takes a different approach. It looks under the hood. Instead of owning all 500 companies, it filters through them using real metrics, profit margins, growth, valuation, and keeps only the best. Right now, that means around 217 stocks, still diversified, but optimized. Since it launched, FELC has outperformed the S&P 500 by around 3% per year. That may not sound like a big deal until you do the math. Let's say you invest $100,000 for 10 years. With regular S&P 500 returns, you might end up with around $260,000. Not bad, but if FELC's performance continues, that same $100,000 could turn into $350,000. That's a $90,000 difference just from choosing a smarter ETF. Now, yes, FELC's expense ratio is a bit higher. It's 0.18% compared to VOO's 0.03%, but you're paying an extra $15 a year for every $10,000 invested. In return, you could be earning thousands more. That's not a fee, that's leverage. And what I really like? It's not just big tech heavy. Tech is about 34%, which gives you growth, but you also get financials, healthcare, and industrials. So you're not just betting on one trend. You're betting on performance across the board. Let's move to ETF number 2. This one's for the tech lovers. ETF number 2, FTEC, Fidelity's Technology Sleeper. If you've looked at Vanguard's VGT, you already know what FTEC is. They both track the exact same tech index. Same companies, same weightings, same returns. But here's where it gets interesting. FTEC is cheaper. Its expense ratio is 0.08% compared to VGT's 0.09%. Not a huge difference, but again, it adds up over decades. More importantly, FTEC trades at a lower share price, around $180 compared to over $600 for VGT. Now with fractional shares, that might not seem like a big deal. But when you're dollar cost averaging or reinvesting dividends, it matters. You get more flexibility and precision. And psychologically, it just feels better owning full shares. Now let's talk results. Over the past 10 years, FTEC has averaged nearly 20% a year. That's wild. If you had put $10,000 into FTEC a decade ago, you'd be sitting on close to $60,000 today. And this isn't a risky moonshot ETF. It holds nearly 300 companies: Apple, Microsoft, Nvidia, AMD, Meta, Google, basically the backbone of the modern world. It gives you exposure to AI, cloud computing, digital payments, automation, everything that's reshaping how we live and work. But what sealed it for me? The resilience. FTEC has been through market crashes. The 2018 tech drop, the 2020 pandemic crash, the 2022 rate spike, and bounced back every time. This is the kind of fund you want on your side if you're in your 30s or 40s and serious about building wealth over time. ETF number 3, FDV, High Dividend ETF with a twist. Most people hear Dividend ETF and think slow, boring, probably something their parents invest in. But FDV flips that idea on its head. This is not your average income fund, your real.com, where most dividend ETFs focus on paying you a yield. Even if the companies themselves are mediocre, FDV filters for quality first. It targets companies that not only pay dividends, but have the potential to grow them consistently over time. So yes, you're still getting that reliable income. The current yield is about 3.02%, which already beats a lot of traditional dividend funds. But here's the twist. It's not just about income. FDV has also outperformed most dividend ETFs in growth, too. Over the past 5 years, FDV averaged about 17.4% annual returns. Compare that to a popular fund like VYM, which returned closer to 13.5%. On a $10,000 investment, that's a $3,000 difference in just 5 years, plus higher dividends. And it gets even better when you look at how the fund is built. It includes a mix of established dividend giants like Procter & Gamble and Coca-Cola, companies that anchor your portfolio with consistency, and fast-growing tech firms like Nvidia and Microsoft, which are now becoming dividend machines in their own right. It's like you're getting the best of both worlds, stability and growth. And one more underrated advantage, the share price. FDV trades around $50, which makes reinvesting dividends a lot cleaner. You're not dealing with fractional shares. You can actually buy full shares when your dividends hit. That may sound small, but over decades, that efficiency compounds. The Fidelity Wealth Triangle strategy. Here's where it all comes together. You've got FELC giving you smart, optimized exposure to large-cap U.S. stocks. You've got FTEC driving growth through top-tier tech. And you've got FDV delivering income with real upside. Put those three together, and you've got what I call the Fidelity Wealth Triangle. Here's how I'd personally allocate it. 40% FELC as your core holding, 40% FAC to ride the growth of innovation, 30% FDV to collect dividends and add balance. With just 3 ETFs, you're covering the biggest levers of long-term wealth: intelligent diversification, growth, and compounding income. You don't need 20 funds. You don't need to day trade. You just need to be intentional with your setup and stay consistent. And if you're between 25 and 50, this structure gives you exactly what you need. Growth when you're young, income when you're older, and performance all the way through. Risks, real talk, and why this works anyway. Now let's keep it real. Whatever then. Yes, these funds have outperformed in the past. But past performance isn't a promise. Things could change. FELC might underperform during a market run where broad exposure wins. Tech could take a hit, and FTEC could feel it. Dividend strategies can lag when growth stocks dominate. Also, Fidelity's expense ratios, while still low, aren't as rock bottom as Vanguard's. That extra 10 or 15 bucks per year per $10,000 might seem small, but over 30 years, it adds up. But here's why I still believe in this strategy, and why I've put a chunk of my own money into it. It's not about chasing trends. It's about combining smart structure with solid fundamentals. Every one of these funds is built with long-term logic in mind. They're not gimmicks, they're just better designed. And the truth is, most investors are still debating whether to buy VTI or VOO, while institutional investors are quietly moving billions into funds like these. That's the game. Either you follow the crowd or you see the pattern and move early. So let me ask you this. Which of these 3 ETFs surprised you the most? Was it FELC's smarter approach to large cap investing? Was it FTEC's quiet domination of the tech space? Or FDV's unexpected combo of income and growth? Drop your thoughts in the comments. I read every one. If this video gave you real value, if you learned something you didn't hear on every other finance channel, hit that like button. And if you want more strategies like this, subscribe to Golden Goals. We break down what actually works, not what just sounds good. And remember, it's not about being the smartest person in the room. It's about making smarter moves than you did yesterday. I'm Mike. Thanks for watching. Now go make those goals golden.